BlackRock launches ETHB on Nasdaq, the first staked Ethereum ETF from the world's largest asset manager. The iShares staked Ethereum Trust ETF began trading on Nasdaq today under the ticker ETHB, making BlackRock the first major asset manager to offer retail and institutional investors a regulated vehicle that earns Ethereum staking rewards. The fund stakes between 70% and 95% of its ETH holdings through Coinbase Prime and passes 82% of the gross staking yield to shareholders, keeping the remaining 18% as a fee split between BlackRock and Coinbase. ETH was trading at 2,065 as of March 12, 2026, up 2% over 24 hours, with BTC at 70,430 and the Fear and Greed Index sitting at 28, fear. ETH held the spot, ETHB adds the yield. BlackRock's spot Ethereum ETF ETH has accumulated over $6 billion in assets since its launch. But ETH only tracks the price of ETH. It does not stake, does not earn yield, and does not compound. Every dollar sitting in ETH leaves roughly 3% annualized on the table. ETHB changes that equation. By staking the majority of its holdings through third-party validator nodes operated by Coinbase, the fund turns a passive price-tracking instrument into what BlackRock's filing calls a total return product. Early 2026 benchmarks put the annualized staking yield at approximately 3%. Though that figure fluctuates with network conditions, validator performance, and the total amount of ETH staked across the Ethereum network. The fund keeps a liquidity buffer of 5% to 30% in unstaked ETH to handle redemptions without triggering unstaking delays. Ethereum's proof-of-stake mechanism requires a variable exit queue that can take days or weeks during periods of high withdrawal demand. By holding a cash-equivalent reserve, ETHB avoids forcing shareholders to wait. The fee math, 0.12% for year 1, then 0.25% ETHB carries a sponsor fee of 0.25% per year, but BlackRock is waving it down to 0.12% for the first $2.5 billion in assets under management during the initial 12 months. For context, ETHA charges 0.25% with no waiver. The staking reward cut is separate from the sponsor fee. Of every dollar earned through staking, BlackRock and Coinbase collectively retain 18 cents and pass 82 cents to the trust. On a 3% gross yield, that translates to roughly 2.46% net to shareholders before the sponsor fee. After the 0.12% promotional fee, the effective first-year yield lands near 2.34%. That is lower than running your own validator, which captures 100% of rewards minus hardware and gas costs. But significantly simpler. No slashing risk management, no uptime monitoring, no technical expertise required. The product targets the same audience that buys bond ETFs for yield rather than buying individual bonds, investors who want the economics without the operations. Why the SEC said yes now, staking in ETFs was effectively off limits under former SEC Chair Gary Gensler. Multiple issuers, including BlackRock, initially filed spot Ethereum ETF applications with staking components and were told to strip them out. The concern centered on whether staked ETH constituted a security and whether validator rewards resembled investment returns under the Howey test. Under Chair Paul Atkins, who took over in early 2025, the regulatory posture shifted. The SEC's Crypto Task Force published guidance in late 2025 acknowledging that staking rewards from proof-of-stake networks could be treated as operational income rather than securities yields, provided the fund structure met specific custody, disclosure, and liquidity requirements. BlackRock filed its original S-1 for ETHB in December 2025 and submitted an amended version in February 2026 that detailed the 82-18 reward split, the Coinbase execution arrangement, and the liquidity buffer mechanics. A BlackRock affiliate purchased 4,000 seed shares at $25 each, putting $100,000 of initial capital into the trust. The approval opens the door for competing products. VanEck, Fidelity, and Franklin Templeton have all filed or amended Ethereum ETF applications to include staking. The competitive pressure on fees will likely intensify as more staked ETH funds reach market. What ETHB means for ETH holders and staking strategies. For individual ETH holders who already stake through services like Lido, Rocket Pool, or directly on the Beacon chain, ETHB is not a superior yield product. Self-stakers keep 100% of their rewards. The fund's value proposition is access and simplicity, not optimization. But for investors who hold ETH through brokerage accounts, retirement vehicles, or institutional mandates that prohibit direct crypto custody, ETHB removes a barrier that has existed since Ethereum moved to proof of stake in September 2022. A financial advisor can now allocate to ETH yield in the same portfolio construction tool they use for treasury bonds and dividend stocks. The institutional implications extend beyond ETF buyers. Pension funds, endowments, and sovereign wealth vehicles that have explored Ethereum exposure through ETH now have a yield-bearing alternative. At $2.65 per ETH and a 2.34% net yield, a $100 million allocation generates roughly $234 million in annual staking income, distributed quarterly. For crypto card users who hold ETH as a spending reserve, ETHB does not replace direct wallet staking. Cards from Ether.fi and other self-custody providers allow users to stake and spend simultaneously. But ETHB could attract capital that was sitting in unstaked spot ETFs, reducing sell pressure on ETH and indirectly supporting the ecosystem that card providers depend on. The competitive landscape just got crowded. BlackRock is first to market with a staked ETH ETF, but it will not be alone for long. VanEck amended its Ethereum ETF filing to include staking in January 2026. Fidelity followed in February. Franklin Templeton, which already runs a tokenized money market fund on Ethereum and Stellar, has signaled it will add staking to its existing Ethereum product rather than launch a separate fund. The fee war that defined the Bitcoin ETF launch in January 2024 is about to repeat. BlackRock's promotional 0.12% rate sets an aggressive floor, but competitors may undercut it or offer higher reward pass-through rates to differentiate. The 82-18 split is not industry standard. It is BlackRock's opening bid. Coinbase stands to benefit regardless of which fund wins the asset race. As the execution agent for ETHB and the custodian for several competing ETH funds, Coinbase earns fees on both sides of the staking equation. Validator operations and custody. The company reported that institutional staking revenue grew 140% year-over-year in its most recent earnings. The broader question is whether staked ETH ETFs will cannibalize existing spot ETH ETF assets or attract net new capital. If ETH holders rotate into ETHB for the yield upgrade, total ETH ETF AUM stays flat. If ETHB pulls in fixed income allocators who view 2.3% yield on a risk asset as complementary to their bond portfolio, the pie grows.